SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Ladies and gentlemen, welcome to this SUERF-Baffi Bocconi webinar. Today we're going to deal with the presentation of the ECB's new Financial Stability Review, which is just fresh out of the press. It was published this morning. And we're very privileged to have the major persons behind this report with us. John Fell, Deputy Director General for Macroprudential Policy and Financial Stability from the ECB. Tamarah Shakir, Deputy Head of Systemic Risk and Financial Institutions Division of the ECB. And we're very happy and privileged to have Olli Castrén from the EBA, European Banking Authority, to discuss. Olli is the Head of Economic Analysis and Impact Assessment Division. We were just before briefly talking about first news via reactions, for instance, one from Bloomberg, which says ECB warns of financial stability risks amid market exuberance. Spillovers of a US correction to Europe could be substantial. Risks to stability are elevated, under quotation marks, and more unevenly spread. And also there is a Bitcoin bubble. The ECB report noted exuberance in crypto assets. So what's all the fuss about, John and Tamarah? The floor is yours.
Thanks a lot for that introduction, Ernest, and good afternoon, everyone. So on behalf of Tamarah and myself, let me first thank yourself, Ernest, and also the SUERF board for inviting us back and giving us the opportunity to present the highlights of the May 2021 issue of the ECB's Financial Stability Review. So this is actually the third issue of the Financial Stability Review that has been prepared against the background of the COVID-19 pandemic. While daily global infections recently reached record highs, they are coming down, and there is optimism that many euro area countries will soon be able to emerge from a third wave of infections. Also, compared to the situation 6 months ago, evidence on the efficacy of vaccines augments this optimism. In those countries where the vaccine rollout has been fastest, so you can include here Israel, the UK, and the US, infection rates have dramatically declined. And although Europe got off to a slow start, the pace of vaccination has been picking up. And this is the background against which our financial stability assessment was prepared. While the FSR covers many topics, our presentation will focus on 4 key messages and their implications. First, we have witnessed differentiated impacts of the pandemic across euro area countries, depending on economic structures, as well as health and economic policy responses. The result has been a clustering of vulnerabilities in some countries and some sectors. Second, in the US, the combination of a sizable stimulus package and optimism about the pace of vaccine rollout caused bond yields to rise abruptly. Spillovers to other asset markets served as a wake-up call about the vulnerability of stretched asset price valuations to low discount rates. Third, investor optimism and sentiment towards the banking sector, well, it has become distinctly more favorable. We have a more cautious view, especially given uncertainties about the adequacy of provisions to deal with rising non-performing loans. Fourth, this issue of the Financial Stability Review includes a special feature that looks beyond the pandemic to the risks that climate change poses for euro area financial stability. Now, while data and methodological challenges still persist, the available evidence suggests that euro area banks, funds, and insurers are all facing material climate-related financial stability risks. So turning to slide 3, the first theme, as I already mentioned, vaccine rollout in the euro area has speeded up. In fact, as you can see on the left, on average, it is around 6 weeks behind the US. Nevertheless, as you can see on the middle chart, there has been more or less continuous downward revision to consensus expectations for euro area GDP growth this year. It's the line in blue there, and that contrasts with the US, where the fastest pace of growth since 1984 is expected this year, with the economy surpassing its pre-pandemic size before the end of this year. Now, that said, the middle chart also shows, so the blue shaded area is the range across euro area countries. It shows that the cross-country pattern of recovery in the euro area is expected to be K-shaped, meaning that some countries are doing better than others. The pattern of sectoral recovery is also K-shaped, as you can see there on the right, with manufacturing performing much better than services. And these differences in growth trajectories underpin the clustering of vulnerabilities that we see. Now, moving to slide 4 and the second theme, while taperless, the US bond market went through a tantrum nonetheless in February and March. Together with the strengthening of the US dollar, which was unexpected at the beginning of the year, expectations of higher US interest rates caused asset price declines, not only in the US, but also across the globe, including in emerging markets and in the euro area. The episode was short-lived, though, as US inflation expectations seemed to stabilize, and that set the stage for an extension of the global equity price rally. And as you can see on the middle chart there, by early May, and that's a cutoff for the Financial Stability Review publication, global equity prices were 75% above their pandemic lows and almost 40% higher than their pre-pandemic levels. Now, the signs of misalignment of equity prices, in our view, from fundamentals, seem to be clearest for the US, where stock prices are significantly above historical averages for price earnings ratios and indeed for other valuation metrics. For the euro area, stock prices are on average closer to historical averages, but as the chart on the right shows, and it's showing a frequency distribution of price earnings ratios from the highest to the lowest, you can see there that the strength of equity markets has created a fat tail of firms with very high price earnings ratios. So you're looking out to the right there on the red line, and you can see that it's above historical averages, and that we think makes them vulnerable to correction. Now, going to slide 5, a notable feature of stock market dynamics after US bond yields started rising was a rotation from growth to value stocks, the so-called reflation trade. So growth stocks such as those of US technology, our newly listed firms that were just recently IPO'd, for example, lost much of the gains that were accrued after the pandemic lows. Now, these stocks tend to be more sensitive to interest rates, and the reason for that is because they're often not paying dividends, and they're valued on the basis of earnings that are coming that may not be delivered far into the future. Value stocks, by contrast, usually are paying dividends, and that makes them less interest rate sensitive, and in fact, some even, such as banks, benefit from higher rates. So in the US, the S&P 500 didn't actually fall, or I mean, the extent of the declines on days that it was down were mitigated by the fact that while growth stocks were falling, value stocks were rising. Now, you could call this an internal correction in the stock market. And it doesn't mean, though, that a US monetary policy induced correction of the US stock market would not spill over to the euro area. As the panel on the left shows, and it's taken from box 3 in the review, you can read more about the analysis there. It shows that a US monetary policy tightening shock that is calibrated, I mean, so we kind of reverse engineer it to cause a 10% decline in US equity prices, asking the question what would happen then to euro area markets. And we can see there that it would likely produce an equally large correction in the euro area, as well as a significant widening of corporate bond spreads, which are at historically low levels, as you can see on the right-hand side. And that widening of spreads would be for both high yield and investment grade, with obviously bigger spread widening for the higher yielders. The sector that seems most vulnerable to a rise of US interest rates is the investment fund sector. Like all other sectors, and you can see it there on the left, except for banks, the sector has increased the duration of its bond exposures over the last 5 years. So they're investing in longer maturity instruments. But different to those other sectors, the investment fund sector is not naturally hedged with equally long duration liabilities in the way that pension funds or insurance companies might be. So that as the middle chart shows, close to a quarter of the debt exposures of euro area investment funds are US exposures, and more than 30% are dollar denominated, making them sensitive to these interest rate changes that I was just discussing. At the same time, the investment fund sector is more exposed to the euro area corporate bond market than any of the other sectors. So apart from the credit risk resulting from a weakened corporate sector, which is one of the themes that we're focusing on in the review, The results of this simulation exercise of a US monetary policy tightening that I just mentioned would suggest that the investment fund sector is especially vulnerable to a rise of US interest rates. Here we're continuing with the topic of corporate sector credit risk. And different to what expectations might have been a year ago, euro area insolvencies have so far not increased. You can see there the blue line on the left-hand side. In fact, they have declined. And this is largely thanks to the favorable financing conditions supported by the ECB's monetary policy, as well as the provision of government loan guarantees and, of course, statutory moratoria, which together have all meant that firms largely have avoided liquidity problems as their cash flows dwindled. However, as those supports are lifted, insolvencies are expected to rise, especially as we think it's going to take some time before revenues are recovered. Now, ultimately, loss given default rate. So if we do get defaults, what matters also is what the losses would be if we had those defaults. They inter alia depend on how indebted firms have become. So looking at micro data on the middle chart, most firms manage to avoid an increase of leverage. But there is a tail of firms, and it's the red line on the chart there, which were already highly leveraged before the pandemic, and they have seen a further increase in leverage since the pandemic. Banks also have sizable exposures to some of the sectors hardest hit by the pandemic, as you can see there on the right, especially wholesale and retail trade, transport and accommodation, where insolvencies are likely to be highest. Real estate activities on this chart are not considered a sensitive sector, and the reason for that is because the bulk of the exposures to hard-hit commercial real estate tends to be with foreign investors and also investment funds, including domestic investment funds, but not so much with banks. Residential real estate markets proved remarkably resilient through the pandemic, and that's thanks to both demand and supply side factors. On the demand side, household income was propped up by policy supports, lower interest rates supported debt servicing, and of course, we know that remote working also probably played a supportive role for housing markets as well. On the supply side, subdued construction activity added to upward pressures on house prices. As a result, in many countries where there were already signs of house price overvaluation before the pandemic, house prices have become even more stretched, as you can see there on the right. Stretched in the sense that they are difficult to explain with the fundamentals. Now, we're not expecting imminent house price corrections in those countries that you can see have large deviations, but rather some moderation of house price inflation going forward. And that's a bit different to the commercial real estate sector, where we have already been seeing a correction, especially for, and you can see that there on the left, for retail commercial properties, the red line, and prices for office properties have also been subdued, the yellow line, although year on year has not yet gone negative. As I said, banks' exposures to commercial real estate are limited. They account for about 7% of their non-financial exposures, but domestic investment funds could suffer losses on their exposures to this market. Changing theme a little bit to sovereign debt sustainability risks, the cobweb on the left here is an attempt at a holistic view on sovereign debt sustainability, because of course the assessment is a multifaceted one, and it's also making a comparison what level indicators were at the height of the global financial crisis and also the euro area sovereign debt crisis. Now, while we cannot say that risks are lower today than they were in those episodes, you can see it simply by the shape of the red line on the cobweb. The sources of risk are different. So, I mean, on the one hand, vulnerabilities from the outstanding stock of debt appear higher today than they were, clearly, because debt is higher than it was pre-pandemic, and also maybe even in comparison, depending on the country, in comparison to those earlier periods of stress. But debt servicing and rollover risks appear more benign, and that's, of course, thanks to continued favorable sovereign financing conditions. Our assessment is that near-term risks are mitigated by these favorable financing conditions, but this of course could change if, for instance, continued fiscal support was required going beyond what is already expected, or if growth outturns fall short of expectations. Turning to the next slide then, and the third theme, it was not really until news about the discovery of effective COVID-19 vaccines that investor sentiment towards the euro area banking sector started to improve. As you can see there on the left-hand side, the stock prices are the dark blue. Euro area bank stock prices have risen since then by almost 60%, and of course, and it's almost back to where it was pre-pandemic, and of course also it has lowered the cost of bank equity. As analyst expectations for banks' return on equity did not change so much after the vaccine news, you can see that the light blue line there on the left-hand side chart. The reason for this impressive increase in bank stock prices seems to be mostly due to lowered uncertainty about the outlook. Now, we now have full year 2020 data for euro area banks' performances, and it's clear that the pandemic had a marked impact on their profitability, and you can see that there on the middle chart, and it was primarily because of higher loan loss provisioning. It explains almost entirely the drop in profitability between end 2019 and end 2020. What we also see is considerable heterogeneity across the euro area banking sector, with some banks in some countries reporting performances for last year that actually would have been considered decent before the pandemic, while others endured sizable losses. And this really comes back to the theme of a clustering of vulnerabilities that I mentioned at the beginning. We expect that the banking sector will be confronted with strong headwinds in the near term. Large inflows into IFRS 9 stage 2 category assets last year indicate that asset quality is deteriorating, as you can see on the left there, and the ECB Bank Lending Survey has been showing that banks have become more risk averse in their lending. At the same time, as you can see on the right, we expect that net interest income will decline further this year. This is based on models developed at the ECB, both because of lower margins and because of lower volumes. In the meantime, since our analysis was finalized, we've also been seeing large euro area banks reporting their first quarter results, and they have been very strong, in many cases beating analyst forecasts. Now, these results would, however, not cause us to change our assessment of the challenging times ahead for the sector, because half of the improvement was driven by trading income, while provisioning was also very low. We still have doubts about whether provisions will prove to be sufficient to cope with the rise of non-performing loans. Now, before concluding the risk assessment part of the presentation, let me turn to slide 12 and say a few words on the policy implications of our financial stability analysis. Whereas economic and macroprudential policies were initially geared towards containing the immediate economic fallout, we have now moved clearly into a phase where ensuring near-term recovery has become paramount. Now, that requires more targeted policy responses and also balancing risks from cliff edges, so including the phasing out of government loan guarantees and statutory moratoria against the risks of a misallocation of capital if those measures were to persist for too long. And to address banking sector vulnerabilities, it also requires responding to uncertainties, including considering options for the management of non-performing loans. So, coming to our overall financial stability assessment, the outlook continues to be dominated by the pandemic, with risks for financial stability that are concentrated in some sectors and countries that had pre-existing vulnerabilities. So far, the resilience of the financial system has been tested by the pandemic, and thanks to policy support, and of course the resilience going into all of this stress, it has continued to facilitate financial intermediation. Now, I said at the beginning that there were grounds for being optimistic that COVID-19 can be brought under control, and for this reason, while we do still see challenges, our assessment of the financial stability outlook is somewhat more upbeat than it was 6 months ago. So let me hand over to Tamarah now, who's going to present the special features.
Thank you very much, John. So yes, in this FSR, we have two special features, one on climate and the other on corporate zombification. So I've just got a couple of slides on each, starting with climate. We've been including a discussion of climate-related risks in the FSR since 2019, actually. In this issue, we brought together a few pieces of analysis that touch on different aspects of how climate-related risk might affect financial stability and show you how we're developing our analysis. Although what we do draw out in the feature is that there are still considerable data challenges with all of this. But one thing that we do develop in the feature is some of our first quantitative analysis of euro area banks' exposures to physical risk, that is the risks that are triggered by climate change itself happening. So for example, in the left-hand chart here, we have external estimates of how individual companies across the euro area are exposed to various physical risks that range from hurricanes, which is actually limited in the euro area, through to floods and fires and droughts, where the red and orange dots indicate high or increasing exposure. But then on the right-hand chart, what the team have done is they've mapped how banks are exposed through their loans to these companies. And where we get to is an estimate of 30% of corporate exposures in the euro area banking system are to firms with high or increasing physical risk. Now that's a big number, so we know that there is some sense of a material risk there. However, of course, a large share of these exposures are collateralized, although some of that collateral itself may be subject to physical risk, although that in turn is probably insured. And where this all gets us to is actually raising some more questions in terms of the fact that we need to understand better how some of those bank and insurance links might play out, depending on how it evolves and who may end up carrying some of the ultimate risk. On the next slide, another aspect of the analysis in climate risk I wanted to draw out, though, is looking at the growth of so-called green finance. This has grown enormously in recent years, and you can see on the left here a tripling in the size of environmental, social and governance funds, and that's in the far left bar there, and a 7-fold increase in the issuance of green bonds, although it's still a relatively modest market. What's more, we've done some analysis looking at trying to understand a little bit better about pricing in these markets, but also resilience. And one finding presented in the feature, which is shown in the right-hand chart, is that while returns on ESG and non-ESG funds are actually statistically similar, the sensitivity of flows to negative performance in the green funds has been close to zero over the last 4 years, which is in some contrast to non-ESG funds, where we see much more sensitivity. So you can see this very muted sensitivity in red lines, but much more sense of outflows in response to relative to returns in the blue lines here, both for equity ESG funds and for bond ESG funds versus non-ESG funds. And that's a positive signal on the potential for developing really resilient green markets. And it tells you perhaps about the commitment of investors to these types of funds and having a long-term view on them. However, as we also discussed in the feature, the growth in this sector makes greenwashing risk much more concerning, and it increases the importance we attach to seeing better standards and alignment across this emerging market, given how investors are approaching it. The other topic we explore on the next slide is around the question of so-called zombie firms. This is a debate many of you will have been familiar with from before the pandemic. There'd been this question about whether there was a material cohort of firms in the euro area that were not very profitable, probably not viable, but somehow still operating, perhaps on the back of very cheap credit and forbearance by their banks. And we tried to approach that debate because it got reawakened in the course of the pandemic by people asking whether or not policy measures may be exacerbating this trend for zombie firms and how the pandemic itself may play out for this firm. What we present in the feature in the FSR is we start with actually backward-looking approach, which was just to ask the question of how many firms in the euro area were in a sort of zombie-like state before the pandemic, and how close they were to being a zombie-like state. There's some of you, I think, on this call will be familiar with that literature. There's a range of ways of approaching this. We picked one approach from Storz et al. And in the left-hand chart, we present in the very darkest blue area there, the one labeled Z equals 1, an estimate of firms that meet that pure definition. And what we see is that there was probably an increase in these firms in the run up to and post the euro area sovereign debt crisis. This had begun declining over recent years, although it was still elevated by the time the pandemic arrived. But it sits at around 3.5%. But though we take this forward in the review, though, to ask the question about, but that's a binary definition, and it just captures firms that strictly meet this definition. What about firms that may have some zombie-like features or may have been close to that sort of state? So still relatively elevated debt levels, very weak profitability, and therefore who may actually be most vulnerable from shifts in the pandemic. And you can see we present a range of measures. So the swathe here, which is the graduated blues, and we assign weights to clusters of firms based upon their proximity to the key thresholds. And even just looking at the 0.9 and above score, so the next sort of darkest blue range, we suddenly go from an estimate of about 3% of firms up to closer to 8% of firms might be meeting the state. So we think that that's still not, an enormous share of firms, but there's a non-trivial number of firms that we're talking about here. We then, though, go back to our basic definition, and the question we wanted to ask was, well, to what extent might these firms that were already in a zombie-like state or close to it before the pandemic have benefited from policy schemes? And here, what we do is we use the criteria from the Commission in terms of the loan guarantee scheme. So we mostly focus on that in the review, and taking those guidelines, which we think are close to what most countries use when we investigated it, we found that in fact, those criteria would have allowed the vast majority of zombie firms to be eligible technically. Now, that doesn't mean that those firms did take it up, and we don't know that for sure. That's something we'd like to come back to investigate in future, but they certainly were eligible. And when we look at sort of circumstantial evidence, so the correlation between take-up ratios in sectors and countries and zombie firms in sectors and countries, we do get a positive correlation between the two, although to a modest degree. So to that, we conclude that it is likely that some zombie firms have probably been able to benefit from the schemes, although taken in the round, that's not necessarily a massive problem, and it still would have benefited aggregate demand in this very troubling period that these firms didn't shut down or lay off staff in this exactly difficult period. But moving then to the next slide, the question we've got is, well, where do we go from here? And I think we do have a bit more concern in the report about the fact, though, that we do see evidence that pricing of risks for zombie firms doesn't seem to be massively differentiated. So we see zombie firms are also likely to be benefiting from accommodative bank lending rates, and we also see limited differentiation in market pricing. On banks, we looked at the fact that we don't see a lot of difference between the interest rates on loans charged to zombie firms versus non-zombie firms. But as you can see in the left-hand chart here, there are very great differences in the NPL ratios, where and on the level of forbearance. And then on the right-hand chart, you see in markets, which would be more about the larger firms where there are less zombies to begin with, but still we see a lot lower range of difference between the pricing of spreads on, say, CCC firms versus BBB firms. So you can see the blue dots at the bottom here representing the latest result are a lot closer together than, say, the green dots from April 2020, or even the red in the middle of the historical range. And so, yeah, taken together, I think we see overall a modest risk from this problem, but it's not negligible. And it still puts a premium on tackling the risk of zombification more fundamentally and looking at insolvency frameworks. And with that, I think well over time, probably, I can wrap up and pass on to Olli.
So thank you, Ernest, for having invited me here. I'm going to split my presentation in two parts. So the first part, I will just briefly make some comments on the presentation that we have just seen. And the second part, I will dwell a little bit more into one of the topics that John and Tamarah both actually touch upon. This is the kind of asset quality, corporate sector stress, forthcoming corporate sector stress, the outlook, and how we see that on the basis of the data that we are collecting at the EBA. Just a quick repeat of the main risks and vulnerabilities that have been identified by John and Tamarah and the team in the latest report. I think the key vulnerabilities that have been identified, they make all a lot of sense, and it's also important to know that all is not related to COVID. So there's a lot of things going on underlying as well. Some things are still coming from pre-COVID times and obviously have not gone away. So geographical clustering of vulnerabilities, obviously we already saw this part of this before the crisis, but it has intensified, that's clear. Market exuberance, I think John showed a very convincing evidence that the stock markets in particular in certain parts of the world are showing very elevated levels relative to valuations. Banks have been stable, so this has obviously been a very positive surprise to all of us and for now. And we will see then how the asset quality performs from here onwards. Material climate-related risks, I think this is really interesting, important topic, and the ECB has done very impressive work, and especially on the physical risk identification and not only transition risk, where the awareness, I think, has in the markets more in general been growing over the past couple of years. Just a couple of interesting details that I picked from the FSR. Zombie firms, obviously, no surprise that media is also picking this up. Very nice piece. Important topic, and I think it also tells us that how lenders should continuously perform their due diligence in order to identify firms, drifting into such a status early on. Growing non-bank exposure to US dollar assets, very interesting piece as well. One question that comes to mind is that how are they foreign currency liquidity buffers constructed? How do they look like? I mean, we know from the recent past that for the banks, for example, they were not always exactly at the level where we expected them to be. So certainly something I think to look at. Corporate sector indebtedness, this is, I think, important to remember that it was an issue that predates the pandemic, has been accentuated by it. Commercial real estate, I think this is a topic which rightly has got some attention in the FSR. What is the future post-pandemic for this industry? And then last but not least, I think it was very interesting to see the simulation of the US monetary policy shock. So time will tell whether Larry Summers will be proven right with his strong views about, in his opinion, excessive stimulus that is being put in place in the US economy. So maybe we move to the next slide. So here I have just some additional issues that in my view would attend further attention. Now, one key point here is that when we're looking forward is that the macro uncertainty remains unprecedented still. We see that, vaccination rates are growing, economies are recovering, but, swings in quarter-on-quarter GDP growth rates of several percentage points can be generated simply just by announcements of tightening or loosening of lockdown measures. And these issues will remain with us for a while still. I think that the discussion that's ongoing in the UK, for example, right now about the latest variant of the virus is just underscores that it will be a while before we are completely out of this uncertainty that will underpin a lot of financial stability risk going forward. Another topic which I think is quite important and is maybe on a more positive note is that during the pandemic, of course, a lot of savings have been accumulated. So household savings rates have been gone to the roof. Lots of these savings have been found their way to bank deposits. What will happen? if and when the pandemic eventually will go away and these savings will be unwound. Third point, I think this is an important one. I think that, we need all this discussion about pandemic and lockdowns and related issues. I think it's quite important to realize that we had quite a few severe disturbances hitting the system throughout this period. We had Wirecard, we had Green Seal, we have Archegos, we had Reddit, and the system survived. I think this is quite remarkable, but question is then that, is this a sign of a true resilience? Is it a sign of the very strong policy support that was in place, or is it just a good luck? I think the answer is probably a little bit all three, but I think Exposed is going to be interesting to make some analysis of these cases to understand a little bit better what really was going on and what are lessons we could learn from these episodes. Moving to a little bit more longer term issues, obviously the pandemic and the response to it may have created severe issues of inequality. So simply just looking at the macro development, it's already clear that the developed market versus emerging market recovery will be very asynchronized this time. Many emerging market countries are only now being severely hit by the pandemic. And when the recovery comes, it might not be even and synchronized across geographical regions. Corporate sectors unevenly hit. This has been discussed already quite deeply so far in these presentations. Asset-owning households may have benefited disproportionately from support measures. I think this is also an issue that we need to keep in mind going forward. And then disruptions beyond COVID. ESG, obviously, ECB is paying a lot of attention to this. I think there's nothing to add. Digital revolution, obviously, is another one, including now discussion also about central bank cryptocurrencies, which will undeniably change the financial intermediation beyond recognition and will create financial stability issues potentially as well. Moving to the next slide, just some numbers of the loans of which have entered moratoria in the EU after the pandemic support measures were put in place. Close to 1 trillion worth of loans have entered moratoria since the beginning of the EBA guidelines were launched. In December last year, which is the latest data point, the March data is being processed as we speak, but it's not going to be out yet for a while. By December, so 1/3 of this moratoria loan was still current. So substantial part of them had already been expired. Some of them had been extended as well. About 60% of those still current in end of last year were set to expire by March this year, which is also the time when the EBA guidelines for loan moratoria have expired. And 80% of the remaining stock in December 2020 is expected to expire by June this year. So this process is ongoing. It's going relatively smoothly. About 1/4 of the existing stock is so-called stage 2 loans, where the credit risk is assessed to have increased substantially, but are still performing. About 10% of them are in NPL status. Largest take-ups of the loan moratoria in lines with the EBA guidelines have been in countries like Cyprus, Poland, Hungary. In euro terms, obviously bigger countries, Italy, France and Spain have been the main beneficiaries of the loan moratoria scheme. Moving to the next slide, we look at another kind of support scheme coming more from the prudential side, which is the public sector guarantee schemes. This is not based on any harmonized centralized guidelines coming from EBA or any other prudential supervisory authorities, but it's more like national support schemes. And this also means that there's a substantial heterogeneity across the public guarantee schemes. So they are much more difficult to compare across countries than the moratoria schemes are. So we have roughly 350 billion of public guarantee scheme loans outstanding for the moment. Unlike for the moratoria, this is growing, at least in some countries, but it still is relatively small. It represents less than 3% of the total loan stock in the EU. You can see in the chart that also the use of the public sector guarantee is heavily concentrated in a couple of countries, mostly France, Spain, and Italy. And the interesting feature of the guarantee scheme, obviously, is that we act as reducing the risk weights of the exposures that the bank are having. So we estimate currently that the average risk weight of the public guarantee scheme loans is roughly about 14% for the time being for the corporate loans, whereas the average risk weight on corresponding comparable corporate loans without guarantees is around 60%. So this also means that banks that are benefiting from the guarantee schemes are also seeing a favorable impact on the risk-weighted capital ratios on this. This is basically just then about where we stand in terms of the non-performing loan exposures. You see in the top left chart, we have a numerator which is measuring the forborne loans. We've been decreasing steadily throughout the past 6-7 years. This decrease has now stopped as a result of the pandemic crisis. At the same time, the growth rate of total loans, which has been accelerated, has also turned down over the last 2 years period. So bottom line is the bank's true asset quality will only be revealed when the support measures are fully being phased out. And moratoria and the guarantees, they have been instrumental to support the affected sectors, but it's very important that the transparency of the bank's balance sheets is being preserved now, so that the investors and market participants have a full understanding of the true credit quality in banks' lending books. The asset quality indicators have not really deteriorated. We have seen big inflows into the NPLs, but we have also seen outflows. There have been, as a very positive sign, in a couple of countries, especially Greece and Italy, still very large NPL transactions. This means that net, the NPL ratio has actually decreased since the beginning of the pandemic. We still see some different practices across countries, so even the provisioning policies and classification to stage 2 loans are not fully harmonized. But the data that we are reporting in our risk dashboard is giving a relatively good and timely picture about where we stand in terms of NPL. Finally, historically, credit losses tend to lag business cycles by 1 year or more. Maybe this time is different. This crisis is very different than in the past. The timely support has probably played a role, but I think it's important to keep in mind that that the peak of the credit problems is clearly ahead of us, which is also what John and Tamarah, I think, very clearly have pointed out in their presentations before here. I will stop there and thank you and congratulations once again for a very, very impressive piece published today.
Maybe John and Tamarah, you want to react immediately to all these points?
Thanks a lot. The points that you made are well taken, and I think we would agree with basically everything. I mean, on the point on macro uncertainty, yeah, clearly it does remain extremely high, although maybe a little bit lower than it was when we presented the financial stability a year ago. But nevertheless, going back, if we compare it today with how it was at the end of 2019, no doubt. And as long as we don't have the full recovery and the conquering of the virus, I think that we're going to have macro uncertainty behind us. I think what the point you make about the unwinding of pandemic savings, yeah, that's clearly a good point, and not only it's a good point as a reminder that we can have upside risks as well as downside risks. Now I know we had been looking a bit into this, and I know that some savings have gone into bank deposits, but when you look across the distribution across households, what you tend to find in most of the countries is a concentration of those savings with the richest households that tend to have a lower marginal propensity to consume. So maybe what you end up seeing is that those savings are, rather than going into the real economy, might be, going into assets, and might in part explain some of the asset market developments that we see. I know that this is frequently, you mentioned the case of Reddit in one of your other points. I think this is what a lot of people were thinking, that households in the US, some households may have been spending their stimulus checks on stock investments. On your point about the system was able to absorb severe disturbances, Wirecard, Greensill, Archegos, we actually had a lot. We did. And any one of those events possibly could have been the trigger for something much more ugly than what we have seen. You're asking the question, do we see this? But I guess this is a kind of a collective we. Do we see this as a sign of true resilience, excess liquidity, or just good luck? I think exactly as you said, it's all of the above, Olli. I think all three factors have been important, but I think that there have been some important lessons learned as well. I can pick out the Archegos one, but I think each of the cases there was a lesson to be learned. But on Archegos, we found, we really found a gap in the regulatory. In the regulatory oversight, let's call it that. It's not a euro area thing, because it was a family office based in the US, but it was able to become incredibly highly leveraged on equities, to an extent that most hedge funds would be very uncomfortable with, and it was more or less completely under the radar. And so it does give cause for concern that there may be pockets of leverage in the financial system that are not well covered by the data that we're gathering. And so I think that is one important. Another lesson, and maybe just putting together all of your four cases there, I think we are seeing discrimination still. It's true that there is liquidity support in financial markets, either directly or indirectly. But I think financial market participants are still discriminating on the basis of fundamentals. And that's why we are still, we're not seeing spillovers from one asset market to the other in the way that we might have seen if there was more herding going on. And then, I couldn't agree more on the pandemic shock having consequences. I think a big part of our you talk about inequality. I think we're talking about K-shaped recovery. I think what we mean by that, it's the euphemism for the fact that there have been winners and losers out of COVID-19, and that is going to have consequences, I think, beyond financial stability ones, but socio-economic ones, perhaps political ones, that go a little bit outside of the scope of the financial stability review, but nevertheless, I think are important.
Thank you, John. Tamarah, do you want to add anything?
No, I don't think so. I would say thank you very much for those really helpful comments, actually, Olli. And one of the things, I suppose, actually a question back to you I did have is on the moratoria and the expiry of those. As I understand it, banks do get some selection, so they can choose within the limits which moratoria they'll expire versus which ones are allowed to continue. And I wonder if maybe in the early days we get some selection bias from banks. I don't know if that's something you've been looking at, but
I have here a question by Gabriel Fagan.
I had basically two questions listening to the presentation. The first question relates to the risks to the investment funds, which you highlighted. Isn't this risk of a very different nature to the type of risk that is faced by banks, given that investment funds are basically intermediaries? and the risk would be mainly borne by investors in the event of a large asset price decline. So that's one question. How would you go about dealing with that? That's the first question. Okay, so second question. I found the climate scenario fascinating, but it raises this issue of the interlinkages between the banking sector and the insurance sector. And of course, in the European context, these are supervised in a sense by different institutions. So it's a question of making sure in some ways there is no gap emerging in the information set regarding banks' risks and the insurance companies' risks. So one possibility here, I don't know whether you've ever thought about it, would be some idea of a climate change related stress test, which would take into account the risks to both the banks and to the insurance sector. I don't know whether you're thinking along those lines. Thank you very much once again.
Good question, Gabriel. Yeah, thanks a lot. On risk to investment funds, aren't the risks largely borne by investors? I think that's true up to a point, and probably during normal conditions that's how it ordinarily works. But when you have stressed conditions and investment funds are facing redemption requests from their investors, which tends to happen when performances of investment funds are poor, there tends to be procyclicality in the investment fund redemption requests. We saw that during the crisis last year. That can put pressure on investment funds to release liquidity quickly, and they can burn through their liquidity buffers rapidly. And I mean, if they don't have cash on hand, then what they're going to have to do is that they're either going to have to try and borrow it, or they're going to have to start selling assets. So then you get feedbacks into the financial markets from forced asset sales that can amplify and make worse a financial market disturbance. So yeah, I mean, it can go. So what I would say, in normal times, it's true that the risks are largely borne by the investors, but it becomes systemic when the whole sector as a whole is under pressure to come back and give the money back to the investors. And then on top of that, the investment fund sector has become very important over the last number of years as a source of intermediation of finance. I mean, they're a large investor in corporate bonds, for instance. And so, I mean, if the sector is unable to, because it's under pressure to pay back investors, it may also not be able to contribute to the intermediation of funds for the corporate sector as well. So you can get kind of credit crunch through the investment fund sector as well.
Thank you. Tamarah, do you want to follow up?
I can pick up the climate question, Gabriel. So actually, I think in some ways you were observing the challenge we face now, which a lot of it in terms of these bank insurance linkages is we need to understand them better. So I think my personal view is that's the first stage, is just one of investigation. Can we get a better sense of how insurance works with this collateral? We talk a bit in the FSR also about this other risk of insurance gaps, so that over time, will there be problems with people being able to get insurance for very high risk property or other assets? But in terms of the stress test, so there are lots of plans around stress testing in climate. It's I guess one of the new big themes. John might be, I think it's probably a little more close to some of the design of those, but there's been a top-down exercise, they call it, where we've released some preliminary results, and indeed there's a box in the FSR on those and more to come. And our colleagues in the SSM are also working on more kind of a widespread bank level stress tests in the coming years. But I think what you're proposing, Gabriel, if I understand, is a system-wide stress test, as it were, for climate. And while it sounds like an excellent idea, I think there may be, I mean, John, you've worked for how many years now on the other system-wide stress test, and can probably speak to the fact that it's not a trivial
It's not a trivial thing. I mean, and I don't want to propose that anybody would do it, but I think part of the question there is, how can you get dialogue going between various authorities that have responsibilities for different parts of the financial system? We do have the European Systemic Risk Board, which I guess is the forum for that, although I'm not aware that there are any plans as yet to do any any system-wide exercise. But if there were sufficient demand for it, I think that would be an obvious place for that to be coordinated.
We have work ongoing also on this in cooperation with ECB. So it's a big topic. It's going to remain a big topic for a while, and yes, I think it's something definitely that we will come back in these occasions for sure in the future.
Okay, thank you. Next I have Thomas Gehrig.
Thank you very much for an excellent presentation and for sharing your information and views. I have a question actually for Mr. Castrén, and actually the statement that you made at the beginning of your talk that I read it as saying, well, the pandemic is a stress test on the banks. It's a lot of a natural or field stress test, right? Stress test in the field. And you said that the banks did surprisingly well. I wonder what the basis of that statement is, because of course at the end of your presentation you said that the real stress test will show after the moratorium are phased out and after the support measures are basically discontinued. So, I mean, is your statement based on stock prices, or is it based on some sort of market information, or what is the basis of that?
Thanks for your questions, and yeah, so I would say that the positive surprise mainly arrived against the background of the concerns, the lingering concerns that were still around there regarding the state of the European banks post the previous crisis. Also, the NPL issues had not gone away entirely during the decade after the crisis, and the weak profitability developments were very well-known issues for all of them who follow European banks very closely. So against the background, against those expectations, I think it's fair to say that it's been a very positive development. Perhaps a surprise to us who are actually looking at these things on a daily basis, but a very positive development to see that the banks actually being able to being instrumental in mitigating the crisis rather than being an accelerator of the crisis, as was the situation just over a decade ago. Now, I mean, there's been a broad range of support measures going into this thing, of which I just highlighted two in my presentation. So there's been a lot of measures on the accounting side, or postponement of implementation of the Basel rules, also operational relief for the banks that have helped them to actually perform this supporting role in the system. But I mean, the real test, what you are referring to, it also will depend very much about the speed and the shape of the recovery. I mean, and this is we don't know how this will play out. We hope that the recovery will be swift and will be complete. But this is the key uncertainty here, and don't forget the savings. What we already highlighted in this presentation. But the bottom line, I think, is that our assessment, and I think this is an assessment shared by the ECB and also the SSM, that the banks are very well capitalized. Liquidity is ample. They will be able to withstand a lot of stress, and as a proof of that, so we are currently performing the biannual European stress test exercise, which was postponed from last year because of the pandemic issue. Results will be published in late July, as usual. And I invite everybody to follow very closely the communication and the results coming from that exercise, which will then provide us an updated information where do we stand at that point.
Thank you, Olli. Next in line is Julia Bormann.
Thank you very much. I'm Julia Bormann from the Austrian Federal Economic Chamber. Thank you very much for the presentations that I found to be very interesting. And I have one question about zombie firms in particular. Should we be worried about zombie firms, and are there policy actions recommended for countries like Austria. In Austria, we've seen insolvencies drop by 40% in 2020 and by about 60% in the first quarter of 2021 due to the support measures and suspension of bankruptcy filings by social security institutions and tax offices. And I was just wondering whether you would say we should do something about it, or should we just watch what will happen? Thank you.
Tamarah is the zombie expert on this panel.
So thank you very much, Julia. I think you sort of hinted at the end there. The way we paint it from our work so far is it's more a risk that we're watching rather than calling the alarm now. And I think the reason being, you cited there a number of facts about the drop in insolvencies in Austria, which I think is very much in line with what John showed about the depressed level of insolvencies in 2020. And it actually seems completely reasonable that we saw suppression of insolvencies during the pandemic. Indeed, I think some of that's also just to do with the fact that literally courts were closed for quite a long period of time, so you couldn't have done it if you wanted to. And therefore, we don't necessarily judge that fall in insolvencies as problematic in and of itself. And the question now is to wait and see, as and when we get the recovery, what happens then, and do we see some correction happening, or do we see correction somehow being suppressed? And I think that's the point at which we start to ask more questions about are we somehow resisting firm turnover in a way that becomes unhelpful or traps capital and resources in inefficient firms?
I myself have a couple of questions. The first one relates to corporate sector default simulations. I mean, all of you are probably aware of the simulations that the IMF has done, Laura Valderrama and others. So my question is, has the ECB analysis on this? Because this is quite relevant to make forecasts of likely corporate defaults. My second question is, what would be the implications then of such loan defaults? This is then where, of course, banking stability comes in, on loan loss provisions, on probability of defaults. A third question linked to this, sort of a policy implication from this, is your view on the role of equity injections to the corporate sector. Will there be needed equity injections? So far, we've mainly dealt with avoiding liquidity constraints as a source of defaults, but going forward, insolvency might become the main factor. So will there be a need for equity injections, and which sources should be used? Is it state sources through state ownership, state guarantees? Is it private sources? And if so, which sources? Should banks even sort of engage in debt equity swaps in order to avoid defaults from their loan holdings by turning them into equity holdings? Would that imply possible adjustments in risk weights for this purpose in order to facilitate such an action for banks? A fourth question that I would have relates to the corporate real estate market. I was quite impressed by your real estate slide, and there was really a dramatic difference between the right-hand side on dwellings and the left-hand side of the chart on corporate real estate, where several important sectors really went down dramatically. So again, does this imply risks for large real estate project developers and therefore for credits, for bank credits to these lenders? And then a final question, if I may, that relates to emerging market economies. Olli alluded to this. It is almost a stylized fact that as soon as there are expectations or actual tightenings of US monetary policies, that emerging markets react with substantial fragilities, capital outflows, and so on. So to what extent would you be afraid of spillbacks to some euro area countries or banks or is this just for analysis in one of the next financial stability reviews? Thank you.
Wow, that was a long list of questions, Ernest. On corporate defaults, I mean, I think this is really interesting. I mean, if you look at, for example, the projections that Moody's had last year, I mean, at the beginning of all of this, Moody's had, they had baseline, and they had positive, and I'm looking at them now on screen, they had baseline pessimistic and optimistic forecasts. And what we have seen in the meantime, the realization has been below all of those forecasts. So below the worst case, below, well, of course, below the best case, but also below, you know, defaults have come in much lower. Now, this is defaults on bonds, which of course are not directly benefiting from those support measures. I mean, in the same way as, you know, the moratoria or the guarantees. They benefit indirectly, of course, through the way in which those supports will support the balance sheet as a whole of the firm. But I mean, I think I think Olli was saying it in his presentation. I mean, it takes time before we see the full impact, and maybe, you know, we've had a transmission of a shock that is still, you know, hasn't fully played out. So I mean, I think the best that we can say, I mean, what we can say at the moment is that there is a lot of uncertainty about how they are going to play out, although it may not be as worse as the worst case. Implications of those defaults. Well, I mean, I did have a slide showing, I mean, say for the corporate bond market. And in fact, there was an exercise that I worked together with the ESRB on last year on the so-called what would happen if we had lots of fallen angels, lots of firms downgraded at the same time. I mean, again, one of the conclusions from that work was actually saying that the sector that would be hit hardest by that would actually be, again, the investment fund sector that I was emphasizing earlier. The role of equity injections to the corporate sector. I mean, that is, of course, an option. I think one of the charts that I showed was showing that the median firm in Europe has not. There was not a significant change in the debt equity ratio for the median firm, but we do have some firms that were already highly indebted that may be getting to the point where it's unsustainable, and you've got either a choice of bankruptcy or an injection of some kind. And I mean, depending on whether that's systemically important, it's important to the real economy, it might warrant. I mean, I think you were asking indirectly whether governments should get involved there, and maybe there might be cases from, externalities or market failure for market failure reasons. On commercial real estate, maybe I said it very quickly. I mean, yeah, we are concerned about the way. I mean, about the way that market has played out. I mean, it has been quite, of course, I mean, it's obvious. People are not working in the office; they're working at home, and that's benefited residential housing, but has not benefited so much the office sector. And of course, with shops closed, the retail sector has also suffered heavily. And that really depends on the pace of, I think, the vaccine rollout and how quick economies get going again. But don't forget, only 7% of the exposures, the loan exposures, it's the share of banks' loans to the non-financial sector that are represented by commercial real estate is only 7%. Now, it might be, that's the average figure. It might be different for individual banks, of course, but I think we're not seeing it as being a systemically important issue for the banking sector alone. As I said, it could have important consequences for the investment fund sector.
So I think time is up. This brings us to the end of our event. Let me thank you a lot for this presentation, to John, Tamarah, Olli. You did a great job in summarizing, 87 pages of financial stability report in half an hour and discussing it thoroughly. Thank you, Olli, for the short notice that you worked on. And thank you to all of you for your participation. Bye-bye and take care.
Thank you very much. Goodbye.
Thank you.
Thank you.
Bye-bye.
Bye-bye.